Most people believe markets react to bad news. A negative headline appears, prices fall. Good news follows, prices recover. That explanation feels logical, and it's also incomplete. Markets don't usually move because of what just happened. They move because of what the majority hasn't fully recognized yet. By the time news reaches the public, it has already been processed, debated, and priced in by participants operating far ahead of headlines. This is where many investors get caught off guard. Large price swings are often interpreted as sudden danger or sudden opportunity. In reality, those moves are frequently the result of pressures that have been building quietly beneath the surface. Shifts in positioning, changes in liquidity, or subtle failures in market structure that don't show up in news alerts. The market isn't reacting emotionally, it's responding mechanically. When prices move sharply without an obvious catalyst, it usually means something structural is changing. Not necessarily something dramatic, but something important. And those changes rarely announce themselves clearly. Today's discussion isn't about predicting the next big move. It's about understanding how markets communicate risk and confidence before those messages become obvious. Because the biggest mistakes aren't made when prices move fast. They're made when investors assume they already understand why they're moving. Over the recent period, both gold and silver have experienced heightened price volatility following strong advances earlier in the cycle. The most notable feature has been the speed of the pullback rather than the magnitude alone. In silver, price moved sharply lower after reaching elevated levels, producing a large bearish candle that marked a clear shift from directional momentum to consolidation. Since that move, silver has traded in a relatively wide but defined range. Price has repeatedly tested the lower boundary of this range near previously established support levels, while rallies have stalled below prior highs. Importantly, much of the recent activity has consisted of overlapping candles, indicating balance rather than trend. Gold has shown comparatively greater stability. After pulling back from recent highs, price found support in an area that aligns with prior consolidation zones. Subsequent trading has remained contained, with gold fluctuating within a narrower band than silver. Relative to its peak, gold has retraced less and has spent more time holding above intermediate support. From a timing perspective, the majority of the decline in both metals occurred rapidly, followed by a slowdown in directional movement. This shift from fast selling to sideways price action suggests that the market has moved from an impulsive phase into a digestion phase. Compared with the prior week, volatility has moderated. Daily price ranges have narrowed, and intraday reversals have become more common. Compared with the previous month, both metals remain elevated despite the recent pullback. There has been no single confirmed macro event directly responsible for these moves. Instead, the price action reflects internal market dynamics, including profit-taking after strong advances and adjustments in positioning. At this stage, neither metal has decisively broken below major long-term support levels, nor have they regained their recent highs. The market is therefore in a transitional state, no longer trending strongly upward, but not yet establishing a confirmed downtrend. This section establishes only what has occurred: rapid declines followed by consolidation, reduced momentum, and clearly defined price zones. No conclusions about future direction are implied here, only an objective description of current conditions. What matters most in the current environment is not the size of the recent price moves in gold and silver, but what those moves reveal about market behavior beneath the surface. The initial decline in both metals represents a first-order effect, a reaction to stretched positioning following a strong advance. After extended upside movement, markets often require a reset. That reset typically begins with profit-taking, especially among shorter-term participants. This process alone does not define a trend change, but it does alter the balance between buyers and sellers. The second-order effects are more informative. Once prices stop falling quickly and begin moving sideways, the market enters a phase of evaluation. Participants reassess risk, exposure, and conviction. This is where confidence either rebuilds or erodes. In silver, the broader trading range and sharper swings suggest greater sensitivity to changes in sentiment and liquidity. Silver tends to amplify both optimism and caution because it sits at the intersection of monetary and industrial demand. As volatility increases, leveraged participants are often the first to adjust. This can reinforce short-term instability even without new external catalysts. Gold's comparatively steadier behavior highlights a different dynamic. Gold is more heavily influenced by capital preservation flows and reserve-style positioning. When gold holds support more effectively than silver, it often signals that risk reduction is selective rather than systemic. In other words, the market may be reducing exposure to volatility without abandoning defensive assets altogether. These dynamics matter because consolidation phases act as decision points. Markets rarely move directly from strong uptrends into sustained downtrends without first spending time redistributing ownership. During this process, weaker hands exit and stronger hands evaluate whether price levels justify renewed commitment. The implications extend beyond short-term price movement. For institutional participants, consolidation helps determine whether capital remains allocated to metals or shifts toward alternative assets. For longer-term investors, these phases influence cost-basis decisions and risk management strategies. Another important consideration is time. Sharp declines tend to compress decision-making, while sideways movement stretches it out. As time passes without a renewed push higher, expectations gradually adjust. This shift happens quietly without headlines, but it affects behavior nonetheless. Ultimately, the current environment reflects a transition rather than a resolution. The market is neither confirming renewed strength nor signaling definitive weakness. Instead, it is processing prior gains and testing the durability of demand at higher price levels. Understanding this cause and effect chain helps investors avoid overreacting to short-term fluctuations and instead focus on how market structure evolves. The real signal will come not from a single candle or headline, but from how price behaves as these pressures continue to interact. Periods like the current one in gold and silver are not unprecedented, but they are often misunderstood when viewed through the lens of outcomes rather than conditions. Historically, strong advances in precious metals have frequently been followed by sharp corrections and extended consolidation, even within broader long-term bullish cycles. What matters most is not what happened after those periods, but what conditions looked like before resolution occurred. In prior cycles, similar environments were characterized by three common features. First, prices moved rapidly away from long-term averages. Second, participation became increasingly crowded. Third, volatility expanded as momentum slowed. In several instances, during the 2000s and early 2000s, gold and silver experienced fast upside moves followed by abrupt pullbacks of meaningful size. Those pullbacks did not immediately signal the end of the cycle. Instead, they marked a shift from trend acceleration to distribution and reassessment. Price often spent weeks or months moving sideways or retracing deeper than most participants expected before establishing a more durable base. What happened before the next directional move was typically a loss of upside follow-through. Prices failed to reclaim highs quickly, and rallies became more labored. This created frustration for late buyers and reduced speculative enthusiasm. Only after that process did the market either resume higher or transition into a more prolonged decline. However, it is critical to note what is different this time. Market structure has changed. Liquidity conditions are more dynamic, derivatives markets are larger, and positioning data is more transparent. Price adjustments today can occur faster, but they can also stabilize more quickly. In addition, the role of gold as a reserve and hedging asset has expanded compared with earlier decades, while silver's dual role remains more sensitive to economic expectations. Another key difference is information speed. Participants now react almost instantly, which can compress historical patterns into shorter timeframes. That means similarities in structure do not guarantee similarities in duration or magnitude. History, therefore, is not being used here to predict an outcome. It is used to filter emotion. It reminds us that volatility and consolidation are normal features of markets following strong advances, and that decisive moves usually come after patience has been tested. The lesson from history is not what will happen next, but how markets tend to behave before clarity emerges. Recognizing that distinction helps maintain discipline and prevents short-term price action from being misinterpreted as long-term signal. At this stage, the most responsible way to frame the outlook for gold and silver is through conditional scenarios, not predictions. Markets operate in probabilities, and those probabilities shift as price, time, and external conditions interact. Below are three structured scenarios that reflect how outcomes could evolve depending on what happens next. Bull case, strength reasserts itself. If gold and silver are able to regain upside momentum and reclaim their recent resistance zones, this would suggest that the consolidation phase is serving as a pause rather than a reversal. In this scenario, buyers would demonstrate renewed conviction by absorbing supply during pullbacks and pushing price back above prior highs with expanding volume. This type of behavior would indicate that demand remains strong enough to overcome profit-taking and that longer-term participants are willing to increase exposure at elevated levels. For gold, a sustained move above recent resistance would likely coincide with continued demand for defensive or reserve-style assets. For silver, renewed strength would imply improving confidence in both monetary and industrial demand. This outcome would require supportive macro conditions, including stable or declining real yields and a lack of tightening financial conditions. It would also likely involve reduced volatility, signaling that leverage has been sufficiently reset. Base case, extended consolidation. If current conditions persist, with price holding above major long-term support but failing to break decisively higher, the most probable outcome is continued range-bound behavior. In this scenario, gold and silver would spend additional time oscillating within established zones. Rallies would encounter resistance, while pullbacks would attract measured buying interest. This environment reflects balance rather than conviction. The base case assumes that neither buyers nor sellers gain a decisive advantage. Positioning gradually normalizes, expectations adjust, and volatility slowly compresses. This type of outcome is common after strong advances and often frustrates participants who expect immediate continuation. From a risk management perspective, this scenario favors patience and selective positioning rather than aggressive directional bets. It also creates clearer reference points for future decision-making. Bear case, trend weakens decisively. If gold and silver fail to hold key support levels and selling pressure accelerates, the market would signal that the corrective phase is deepening. In this case, downside momentum would likely be driven by further position reduction, rising real yields, or strengthening alternative assets that compete for capital. Once support is broken, price often seeks lower areas where longer-term demand previously emerged. This scenario does not imply a permanent shift away from precious metals, but it would suggest that current price levels were not sustainable under prevailing conditions. The market would need additional time and lower prices to reestablish equilibrium. Importantly, even in this outcome, the process would still be viewed as part of a broader cycle rather than an isolated event. Long-term participants often re-engage only after downside pressure exhausts itself and volatility stabilizes. Across all three scenarios, the defining factor is confirmation through behavior, not assumption. Markets communicate through follow-through, not through isolated moves. The purpose of outlining these scenarios is not to assign certainty, but to remain prepared. By framing outcomes conditionally, investors can adjust as evidence changes, rather than reacting emotionally after the fact. Rather than focusing on daily headlines or short-term price fluctuations, my attention remains on a small set of indicators that tend to lead behavior in gold and silver, not react to it. One of the primary reference points is the US dollar index, DXY. Sustained strength in the dollar can act as a headwind for precious metals, while periods of stabilization or weakness often relieve pressure. What matters most is not a single move, but whether the dollar begins to trend or remains range-bound. I am also closely monitoring U.S. Treasury yields, particularly real yields. Rising real yields increase the opportunity cost of holding non-yielding assets like gold and silver, while declining or stable real yields can support demand. The interaction between nominal yields and inflation expectations provides important context for metals pricing. Inflation data such as CPI and PCE are another key input, not because of individual releases, but because of how markets respond to them. The reaction function, whether price moves persist or fade, often reveals more than the data itself. From a market structure standpoint, volume and liquidity are critical. Healthy trends are typically accompanied by expanding volume on advances and contracting volume on pullbacks. If price moves occur on diminishing participation, that often signals fragility rather than strength. I also pay attention to open interest in positioning in futures markets. Rising open interest alongside stable price can suggest new participation, while declining open interest during price moves often reflects liquidation. These dynamics help clarify whether moves are being driven by conviction or by forced adjustments. Finally, I watch how gold and silver behave relative to each other. Divergence between the two can provide insight into whether the market is prioritizing stability or risk sensitivity. Taken together, these indicators form a framework, not a checklist. None of them provide answers in isolation, but when they begin to align, they offer clues about whether the market is building toward resolution or remaining in equilibrium. At this point, the most important takeaway is not a specific price level or short-term forecast, but the recognition that the market is in a process rather than at a conclusion. Gold and silver are transitioning from a period of strong directional movement into one of evaluation. That process takes time. It involves adjustments in positioning, shifts in expectations, and periods of uncertainty that can feel uncomfortable if viewed without context. This is where discipline matters most. Risk management, patience, and an awareness of probability allow investors to respond thoughtfully rather than react emotionally. Markets will eventually resolve higher or lower, but those outcomes tend to reward preparation more than prediction. Nothing discussed here should be interpreted as investment advice. It is simply an analytical framework, one way of reading the market based on structure, history, and observable behavior. Staying focused on what can be measured rather than what can be feared is often the difference between long-term consistency and short-term frustration. This isn't about being right, it's about being ready.